The stock market is a great place to invest your money. But before you go and start investing, let me tell you 10 things that are very important for new investors. So, here we go. 1. Investing in stocks is one of many options for investing your money. Stocks are a popular avenue for investment, but it's far from the only option. Depending on your needs, income, and when you need access to the money, you can take advantage of a variety of different investment strategies. These include putting money in a savings account, purchasing real estate, or investing in bonds, precious metal, and foreign currency. All of these investment strategies involve varying levels of risk and return. 2. Investing in stocks comes with substantial risk. While stocks are often viewed as a safe investment strategy in the long term, nothing is guaranteed. The stock market is volatile, especially in the short term, and can swing wildly in between extremes. One day you might get thousands from your investment, and the next day you could find yourself to be poorer than when you invested. Investing in stocks isn't for the weak of heart. The stock market has historically grown at an average rate of about 7% per year. From year to year, however, the stock market can experience dramatic highs and lows. Even over a long period, a return on an investment in the stock market is never guaranteed. As they say, big risk, big reward. 3. Use a brokerage. Investors generally invest in stocks through a brokerage firm. To do so, they must open an account and deposit money. Once you've added money to your account, you can direct the brokerage to purchase a certain amount of stock. A brokerage usually charges a small fee for these services. Now, an unpredictable stock market and stay-at-home restrictions are encouraging trading activity and new accounts on mobile devices. Take Robinhood, for example. Its simplicity and free service made its app and website reach 10 million accounts in 2019. Combine it with low trading costs, and you've got an effective model for curious newcomers who aren't ready to trade large quantities yet. Charles Schwab and E-Trade, 3 of the largest online brokerages in the US, have also added hundreds of thousands of new accounts since January 2020. It looks like everyone is out to earn some money or baby lose all their saving. You never know with the stock market. 4. Different brokerages have different strengths and weaknesses. Not all brokerages are the same. Depending on your investing needs, you may want to pursue brokerages with different strengths and weaknesses. Some might have especially robust customer service, while others may offer low or even no fees. Which brokerage is right for you will depend on your investing goals and how much guidance you need to invest. There's no one-size-fits-all in investing, so you should explore the best stockbroker for you. 5. Don't invest all your money in the same stock. It can be tempting to go all in on a promising young company that you think might turn into the next Apple or Amazon. However, investing all of your money in a single company is a risky proposition. Ever heard the phrase, "Don't put all your eggs in one basket"? Well, it applies here. You can never be 100% sure about a new company's growth, so don't throw away your money. Make safe investments, at least until you are more experienced. 6. Spread your investments. A great strategy for reducing risk to your investments is spreading them out. This means that you invest a little in multiple companies, so even if one goes under, you will still be profiting from those that remain. I like money coming into my pocket and not away from it. If you are a normal person, I believe you have the same feelings. So you don't need to take any undue risk by investing in things you don't understand. 7. Dividends. Dividends are small payments that companies distribute to shareholders, usually quarterly. If you own shares in a company, you'll usually be eligible for dividends. Dividends are usually a small percentage of your initial investment, but they tend to add up, especially if you have invested a lot of money in the stock market. These payments really come in handy when you are going through a financial crunch. 8. Mutual funds. Mutual funds are collections of investments. These funds can be composed entirely of stocks, but can also include other types of investments, such as bonds, precious metals, and foreign currency. Mutual funds generally charge a small fee each year for maintenance and management costs. What exactly a mutual fund invests in and how it is operated varies from company to company, so be sure to do your research. 9. Index fund. Index funds are a common type of mutual fund. They usually operate under a very simple set of parameters and often invest in shares represented in a stock market index like the S&P 500 or the Dow Jones Industrial Average. I guess these guys don't like to take risks. Since there is minimal management involved, the fees charged by index funds are much lower. Index funds are usually a good choice if you're trying to match the return of the stock market as a whole and diversify your investments as much as possible. And, as I said, diversity is sometimes the key to success in the stock market. The good thing about index funds is that you don't need a lot of research and they give you returns that match the market. Usually, novices aren't Warren Buffett, so you need to stick to simple investments that you understand. 10. Taxes and tax deferral accounts. Everyone is afraid of taxes, but with stocks, you don't need to worry that much. In retirement investments, you have to pay the usual income tax and tax-deferred investments. On normal accounts, you owe tax on your profits and dividends. The big cut usually comes when you're transferring your investment into a bank account. That's when the axe really comes down, and you should keep a safety net of around 20% to be on the safe side. Well, if you are still worried about taxes, then let me tell you about tax deferral accounts. For retirement, tax-advantaged retirement accounts are usually your best option. These can include 401ks, IRAs, and other types of retirement savings accounts. In most cases, these accounts are tax-deferred, meaning you don't have to pay income tax on your money until you withdraw it during retirement. This can help your money to grow over time. A popular retirement investing option is a targeted retirement fund, which takes into account the time until you plan to retire and adjusts the level of risk in your investments accordingly. Investing, in general, doesn't need to be a difficult and arduous process. The stock market has so much potential, and you can grow your savings substantially if you are smart about it. Go to a brokerage firm, open an account, and shop for the stock that suits you the most. But before you invest in anything, do your research. As I mentioned earlier, the stock market is an extremely mercurial entity, and your investment can go from anywhere in the hundreds of thousands to a couple of thousand of its worth within minutes. So, if it's your first time investing, then take a careful look at all the things I have mentioned earlier and try not to go overboard with your investments. So that's about it for folks. I hope the video was helpful for you guys. And don't forget to hit the bell icon to receive instant updates from our channel. Like and subscribe to see similar videos directly on your feeds.